Welcome back, and we now continue with our key theme of sustainability. Our previous panel began to touch on how regulation could be used to help improve the prospects of how businesses tackle this big issue. And this next panel will be looking at whether that regulation is fully making ESG fully integrated and demanding more from companies in terms of future-proofing. And indeed, we'll start to look at how these initiatives can be properly measured. And I'm delighted to introduce the moderator of this next expert panel, Chief Economist at TS Lombard, Charles Dumas. Charles, over to you.
Thank you very much indeed, Emma. And let me introduce the three members of our panel. The first is Fiona Frick, CEO of Unigestion in Geneva. Then we have Euan Munro, who is CEO of Aviva, and we have Caspar, who is the CEO of the investment arm of Edmond Rothschild, also in Geneva. The subject is obviously the question of integrated use of ESG in investment approaches, and we've had this year the Shareholder Rights Directive that is Europe-wide, and we have the upcoming MiFID changes in which ESG becomes part of the accounting framework of firms reporting. And there's also in the UK a 2020 update for the Corporate Governance Code. So if I can turn first to Fiona, how much is this ESG view now fully integrated into your whole investment approach? And I suppose particularly I should ask, is asset manager remuneration tied to ESG goals and their integration?
Okay, so I would say that for us, ESG integration has been a journey. It started in 2004 because some of our institutional clients in the Nordics asked us to integrate some ESG factors in the equity mandate we were managing for them. So as always, ideas come from our clients, and that they teach us how to progress. We started mainly in equity at that time, and it was more of an exception, mainly something which was asked by the Nordics. And what is interesting is that through the years, it has been a phenomenon that went from one country to the other in Europe, and it has been today mainstream. So France with the COP21 made a big step forward in terms of environmental regulation. Then there is the UK with the stewardship code. So it has become global in terms of Europe, at least. And what is interesting also is that it has moved from one asset class to the other. So it's not sufficient to do it only on equity, but you also have to do it on bonds and also in private assets. So I would say that today we integrate ESG factors in equity, bonds, in private equity, and also in the funds we invest in. And I would say that out of our 20 billion assets under management, there's around 51% where there is systematic integration, and the goal will be to be at 100% in 3 years.
Thank you very much indeed, Fiona. Euan, do you have anything to add to that?
I think every fund manager will have integrated things, in slightly different ways. We would certainly claim that we have integrated ESG into, like Fiona, all of our asset class processes. Again, strongest initially in equities, where a lot of it came from us exercising our voting rights, but then moving into credit and real assets. I think the real challenge for us looking forward in terms of future-proofing our businesses is going to be developing informative reporting for our clients. Really, the burden of proof is now on us to demonstrate that all the work we're doing with ESG is not just making the world a better place. I think we have to demonstrate that. We've also got to demonstrate it's reducing risk and improving returns, and validating those claims and showing it through reporting is going to be the next big challenge.
Thank you very much, Euan. Christophe?
Yes, I mean, the way we approached ESG is probably a little a little different. I mean, being a family business, we started with actually investing for a family, so the Edmond Rothschild family, in private equity on real assets, well over 10 years ago. I think that's an angle where ESG or impact investing are very naturally not only aligned, but even more fruitful. Then, just to go over the history, we expanded that in liquid assets. And the aim, just to be clear, is actually similar to what Fiona mentioned, is to be 100% ESG in all our liquid assets by end of 2001. One debate which could be interesting to have is the famous labels, because you can have ESG integration, which is like the basics which you need to do in that space. The next step is either impact measurement, which is much easier in real assets, and we may well talk about that at some stage, I imagine, or the label format in liquid assets, which opens a whole kind of worms on which label, which country, and so on.
Yeah, I suppose actually what's become very topical just this year is this question of carbon neutral intentions of British Petroleum to start with, and then quickly followed by Shell. But of course, these guys are going to be trying to be big in renewables as well. So how do you see that working out as an investment matter, or as an investor for that matter? Fiona, do you want to have a shot at that?
If you want, then please give the floor to somebody else. I think there are different companies. For companies for our side, which was still considered as a specialist asset management, the best thing to do for us is to participate to some collaborative engagement. And typically for the topic you mentioned, which is oil companies, there's an excellent one, which is Climate 100. That is really a collaborative effort between investors and asset managers to engage with company and vote in a way to favor this capital allocation to change for oil company between brown energy and green energy. So the energy transition will come not only by investing in new technology and new companies that come with innovative technology, but also by engaging with conglomerate in oil to make them become energy producer rather than oil producer.
Thank you. Euan?
Yes, I totally agree. And I do think that an important role that we have as investors is to engage with the big polluters and the mining companies and so on. I think there's a strong temptation, perhaps from a commercial point of view, just to make your portfolios green. So make your portfolios low carbon. And of course, you can do that by avoiding sectors that are carbon intensive. But the problem with that is you're making you've got a virtuous portfolio, but you're not actually changing the world. So if you do want to change the world and change the nature of energy, you do have to engage with the world's biggest polluters. And if, as an investor, you believe encouraging them to behave better will improve the investment return. So I think one of the big debates about ESG is it really just virtue signaling, or does it lead to better returns? And our view is that these are real risks. When Rio Tinto tore up Aboriginal caves, it was destroying shareholder value. It was bad behavior, but it was also destroying shareholder value. And so if we can stop these dumb things happening, engaging with companies, getting them to behave better, improving their mix, then we will make the world a better place. But I think you've got to talk to the messy industries, because as an economy, as a society, whether we like it or not, we're still going to have to use oil for a while. And so let's make sure that's as clean as it can be while we transition. Yeah, absolutely. Christoph, do you have any angle on this?
I can only agree with my two colleagues. The thing I'd probably add is I wouldn't oppose durability and actually returns. And maybe if we take a long-term framework, I mean, it can be potentially in the very short term, say, hey, yes, there's an opportunity in XYZ stock or sector, and from a price point of view, but this one is not clean. So if you put yourself in a long-term framework as an investor, and that's why I think again conviction investing as in liquid or liquids, if you stretch your time horizon, you can actually make a change on the company and actually work on companies to make them change. And I will go even further. As an investor, you can actually identify themes, thematics, which at the origin of the way they are built will actually be sustainable or impactful. And that maybe is even a better way to actually deal with the whole issue of ESG.
Yeah, one of the things that struck me in all of this is that it's not just a question of stranded assets in the energy world. What about something like the insurance business, where you know, you could easily envisage certain things becoming uninsurable because of the surprises which the lawyers sometimes spring on you as a operator of anything. So we had, you know, asbestos in the 1980s. We had the big oil spills, and we had Lloyd's practically going down the tubes. You know, none of that was anticipated in the policies that have been written 10, 15, 20 years earlier. So it's a major part of the financial sector which is also threatened, I should have thought.
Yeah, do you want me to sort of make a comment on that, Charles? Just
sure.
Obviously I'm Aviva investors rather than the insurance side, but I have a bit of an insight into insurance. And you're right. I think you know there is a strong link between risks that can be insured and the risks that are thrown up by ESG factors. So, for example, I would say, you know, Vale's negligence in maintenance of its tailing ponds and so on, and lack of care for the communities that they were drawing their workers from, led to the Brumadinho disaster, where the tailing pond burst. And obviously, to the extent they've got that covered by insurance, somebody's got a big bill. So definitely insurance companies, including Aviva, are building ESG thinking into what they're willing to underwrite. And that will feed back to companies that are badly behaved. As among the other costs that they incur will be much higher costs to insure their enterprises. So I definitely think it falls into that category of ESG isn't just putting a green sticker on things, it's the management of genuine business risks. Yeah,
thank you very much. Does anyone else, either of the other two, have you got something to say about this?
I would say that coming back to insurance, and I think it's the role of the capital market is making sure that companies that don't behave well will have a cost of capital or a cost of insurance that will become higher than the other one. And that, as a market, the job will have been done. And by not investing in companies which have bad practices or making these practices difficult to insure, we'll have an incentive to make them evolve to something better. And it's really about seeing ESG not just a risk for the environment, but also as a financial risk.
Yeah, well, I completely see that, and both of you have made that case rather strongly. But what I'm slightly concerned with is that you know, we've now seen a little bit of pressure exercised on China, and they've come up with a commitment to be carbon neutral by 2060. But at the moment, there are reports in the newspaper today that say that we're going to be we're not meeting the Paris targets in terms of the IPCC and all the rest of it, and specifically that the warming that will occur will be more than 2 degrees, and that of course is potentially very damaging indeed, especially in the long run. But it's entirely possible, to my mind, that at some stage in the not too distant future, people will start saying we have to become carbon negative at some stage in some fashion. And, you know, that's going to create threats which we simply don't know what they are at this point.
I think you need to be, I agree, you need to be careful, because at the end, avoiding to the maximum to do harm is great. But you still have at some stages, some parts of the industry and some way you function, at least in the middle term, that you can avoid. I mean, I take one example. We are relatively big infrastructure investing, in our private markets. And there, one of the stated aim is actually to save at least a quarter of, when you emit one CO2, you save 4. And in my view, you already go a long way to making things better. I mean, I'll give another example. Last year, our investments generated 22,000 tons of CO2 savings. Of course, you probably produced a quarter of that, but you need in a long time frame maybe to avoid most of that. But in the short end, what you're describing is potentially scary and not in the interest of the globe as a whole. Huh?
Yeah, well,
sorry, Charles. Can I make a comment on that? I think one of the things that we have to guard against is making sure that we don't make too short-term assessments on the carbon impact of investments. So to give you some examples, as we build out alternative green energy, it's actually quite carbon intensive to build solar arrays and wind farms and so on. Over the lifetime, they will obviously retire the burning of fossil fuels. Likewise, we invest in biomass plants, some of which burn, really messy stuff like we gasify, bin liner waste and burn that. And in actual fact, obviously, we're putting carbon dioxide into the atmosphere, but it's far less greenhouse warming than the methane that would be produced if that same waste had gone into a landfill site. And so you have to take a balanced approach to understand the consequences, both what you're removing and what you're adding. And there is a carbon J-curve as you invest to build back better, greener, etc. And so one of the things I'm nervous about is there's going to be this clamour for us to have instantaneously green portfolios, which will lead to harmful virtue signalling. We need to actually take a long-term view, build better infrastructure that will have a carbon footprint, but will bring a long-term benefit. So I do not want us to be short-term about this.
Yeah, well, I'm bound to say that what I think you're talking about here, Euan, directs us towards a sort of pretty comprehensive carbon accounting approach, and that will certainly be needed if, as is quite possible, we go down the route of a carbon tax, which, given the state of the revenues in most European countries, or indeed most countries in the West, a carbon tax could actually start to be quite an attractive proposition. So how do you feel about carbon accounting? Do you think it's a feasible thing to do, especially vis-a-vis imports from countries like China?
I think it would be a good thing if we could price externalities in the accountings of firms, because at the end, what we realize today is that what is scarce is the environment, biodiversity, water, etc. And for the moment, it is not priced as a cost for companies. So it would be much more interesting if it was part of a P&L account with a price attached to it. Like that, we could have a better way of comparing companies to each other. So I would be for a carbon tax, and one which is reflective of the reality. Because for today, there is a price on carbon, but we all know that it's much too low in regards to the reality.
Yeah, I think the numbers I've seen say that carbon tax to achieve the results desired would have to be in the region of $75 to $100 a ton. And I don't know if any of you have comment to make on that.
Yeah, I don't really, Charles. It's not something I'm an absolute expert in. I just would be concerned that it's taking into account the full benefit and the lifetime of assets that are being built. But I agree with Fiona. I think there's only so much we can do as asset managers, and we do need policymakers to take their end of the load as well. with appropriate taxation policy to make sure the polluter pays.
Yeah, well, of course, the sort of elephant in the room in this whole discussion is where's the United States in all of this? And one gets the impression that they're really sort of not really on the map in terms of pursuing any kind of ESG accounting.
I would be less negative than you on that. I think there is a difference between what the political arena says and what you see when you speak with pension funds in the US. Perhaps they've always been very strong on the S part and the G part, because now typically diversity of employees in a company is very important there. And they're becoming more and more aware of climate risk, and obviously the fires in California will make them even more aware. But when you speak with pension funds, they have the willingness to integrate ESG in their portfolio. So I would say that there is a different tone between the top political arena and the one which are really investing on the bottom.
I do agree with this view. I mean, US firms, asset managers, have been relatively late to the game. For many years, I remember 10 years ago or so, when from a European angle, you mentioned ESG, and having at that time been part of a global US firm, the discussion was, well, the broader you have your universe academically, the more choices you have, the more you have chances to create alpha. And I think now probably coming from the consumers, like Fiona mentioned, the pension fund and the end consumer, the asset management industry as a whole, as the US has leapfrogged, the position that they were in before, and embracing it quickly. One thing I would keep an eye on then, and I put here briefly ahead of a fund selector, is again the greenwashing angle of firms trying to catch up on something they didn't believe in, and now that they need to do because the customer asked it. So that I'd be a little careful. I'm not saying that's the case of most US firms, but it may be so, because how do you explain that 5 years ago it wasn't on the agenda, it wasn't the way they believed in it, and they had a bunch of PhDs who explained that actually didn't make any sense, and the broader your universe, the more stock-picking opportunities you had, to suddenly 5 years later wanting to be at the forefront of it. So that's just another slight angle. Doesn't answer the political question really, but I think it answers partly the US investor angle.
Yeah,
I think just I agree with my kind of co-panelists that the US isn't necessarily represented by its president in this regard. But I think Fiona touched on a really important point, which is the S in ESG, and whether it's been, I don't think it has been directed from the top, but America has drawn all of our attention to the importance of the S during the COVID crisis, probably triggered most memorably with the George Floyd murder. And I do think that as asset managers, this is panels about how do we embed ESG. And one of the things, we lack moral authority to talk. I think we're pretty good at the E, actually. That's why we like talking about it. But the S, we don't have enough senior women. We don't have enough Black people in our industry. And I think that we are going to really have to change that if we're going to have the moral authority to talk about the S factor. So that's something we've got to work on.
Okay, well, we've traveled across a large quantity of the outlook, and of course one knows of people who made an enormous sum of money just investing in tobacco companies. So I think what I'm hearing from you guys is that in fact the investment industry is now much more proactive than it has been in the past in relation to the behavior of management and really the future of the economy.
Yeah, I do think so, Charles. But I think one thing where we can make a difference between we're talking about impact, making a difference to the economy or to the population, is actually with investment themes where you put your money at work to make a difference. And I'll take an example. We talked about the S a little bit. Now in the COVID crisis, more than ever, social housing, which, for affordable housing, if you want, is it in the UK or elsewhere, inequalities, is a big issue. So if as an investor, we can actually join sometime government aid and opportunity to get return while doing the goods by providing social housing. On the UK, I think is a great example where social housing, affordable housing, as we call it, can make a great impact on the topic of measurement, which we didn't talk too much about. You can concretely say, hey, you have created whatever 1,200 or plus social houses that make an impact on the difference. Again, and here I'm talking more private markets, but you can replicate that in a number of other thematics. Is it on the S side or E or even G side?
Well, I think the sum total of real estate investment taken all told, and real estate wealth, is actually greater, significantly greater than the sum total of equity wealth. So, so anything that can be done in a positive way through the housing market or real estate in general is pretty positive. But I suppose in some ways, almost inevitably, one is talking about reacting to events, and the COVID crisis is a classic situation that essentially the outcome is determined by reactions. And what we're looking at the moment, of course, is that a lot of sort of office blocks are not going to be viable anymore, or indeed some shopping, high street type activities will be reduced in scope. And on the other hand, there is this sort of housing shortage question. So it really, the ESG comes right back into the planning process, doesn't it?
No, it does.
It does. I mean,
sorry, Euan.
Yeah, I was just going to say it does. And I think one of the things we need to recognise in industry is we do have our limitations. We do need to work hand in glove with government. I don't think it's necessarily the same old-fashioned, private-public initiatives. It might be working with the government. They create some of the public good assets, and we create some of the, for example, whether that's high-speed 2 or whatever, and then we build the infrastructure around about it that benefits from what they've done. But yes, it's got to be a partnership.
Well, we've only got about 2 minutes left of this session. So has anyone got any last words they want to stick in before we're finished?
What I would say is that we have an incredible opportunity, because a lot of the credibility and trust of the financial industry had been a bit hurt in the 2008 crisis. And this crisis today gives us the possibility to show that we have a purpose, which is to allocate capital from people that need wealth for the future to industries that needs investment for the future. So this crisis permits to put asset management in a role where they can show the purpose, which is asset management allocation between those in needs of savings and those in needs of capital.
Yeah.
Fiona, thank you very much indeed. Euan, is there something you'd like to say?
I was just going to make the point that I think Christophe has made it, that there's been quite a lot of Damascene conversion to ESG over the last little while, and I do think that people should look at. I think the European asset management does have a very proud history. We've certainly been voting shares actively and aggressively since the 70s, and so I think you can't synthesize decades of history. So do look at, the heritage of engagement from the industry. It's become fashionable, but some people have been doing it for a very long time.
I think Europe should be proud of being, for once, at the lead here.
Mm-hmm.
Good. Well, on that note, I think we'll draw this discussion to an end, because we're actually about a minute from home, and I hand you back to Emma, who is in the studio.
Charles, thank you so much. And what a thought-provoking conversation that was. So many points to come out of that. Beware of short-termism, avoiding greenwashing. Euan there talking about joined-up partnerships, possibly between public and private bodies. A look about carbon neutrality being a long-term goal, not just a short-term one, and also how social responsibility mixes into all of that. So a fantastic conversation and debate there. And if you'd like to get involved more, I'm delighted to say these panellists will now be joining one of our virtual meeting rooms, so you can go and join that conversation, turn your camera on and really get involved and have great access to those key speakers there. So we're now going to go into our relaxation break, but we'll see you in 10 minutes.